Hi, everybody. This is Dan Sheridan at Sheridan Risk Management. Hope you're doing well. And I want to talk today on a strategy I did maybe a year ago or a year and a half, um, but I wanted to talk about it. And I call it the Centaur strategy, Centaur. You could also call it a hybrid. And I called it Centaur because it's kind of I was thinking, what was that? Not Narnia or one of those where what was it? Thomas was half, maybe that was a different one, but he was half horse, half human, and kind of a hybrid. And that's what I'm thinking of with the centaur or hybrid. This is kind of a combination of a diagonal, which would be a poor man's covered right, and a calendar. So it gives you a strategy that would be kind of like a covered right without options. But the nice thing about the centaur or hybrid, it gives the opportunity to make a much better yield potential than a covered right. And it's tremendously less cost. And this is just a little example of it. Here's your typical, if I buy 100 shares of Apple and I go sell a call against it. In this case, okay, the market's down 46 points today. And let's see, Apple is down $4.87, traded at 228. So let's say I wanted a little more downside protection. So, I'm long 100 shares of stock and I sell one 230 call, which is just slightly out of the money, but we'd call it at the money. Well, you can see the graph, right? If we're at $228 right here, that's the graph, which looks like a covered right. The blue line is more expiration graph. The purple is how it looks today. And this says you're about 52 deltas long, well, on the whole trade. So you're long 100 shares of stock, and stock, in terms of deltas, would be 100. And then we're selling this call, Feb 28, 21 days out, the 230 strike. It'd be the 230 strike, a little bit above where we're trading at. And that would have a delta, close to, well, let's say it's pegging it here around a 48 delta, right, for the short call, which is just slightly out of the money. So your deltas are about 52. You can see that. What does that mean in English or Spanish or Somalian? It means that, just think in terms of stock equivalent. If I'm long 52 shares of stock, goes up a buck, I make 52 bucks. Goes down a buck, I lose 52. All right? Pretty simple. The problem with this, when you do a covered right in Apple, it's going to cost you like $22,000 because the stock is 228. So if you buy 100 shares of stock, it's like 22 grand. And you can reduce that by the premium of your short option of 4.25, but you still have 22,000 there, right? So it's going to drastically reduce your yield just because you're putting a lot of capital up. So what I did is I kind of combined the world of a diagonal, a poor man's covered right, and a calendar. And here's an example of that trade, a much cheaper alternative. So now we go in and buy one April 17, 225 call. So this is out about, in this example, on the April 17, we're out about 69 days on the long. And I'm buying the 225 call, slightly in the money. And then I go sell the same strike as I did above, the Feb 28, 230 call. So this would be called a diagonal. What's the definition of a diagonal? Different months, different strikes. Here I'm buying the April 17, 60 some days out, selling the Feb 28, 21 days out. And so, but if you look here on this diagonal, which looks kind of like the graph we just had. And again, we're at about 228 right now, and we sold the 230 call. But instead of putting up 20-some $1,000s, this diagonal, this hybrid or centaur, as I call it, it's about $760. And I try to, and this makes not just small investors, but anybody who wants to put less capital but get a better yield potential. And I can keep the deltas. When you do this, like buy a strike in the money, sell something at the money, you look at my deltas are only 13. So it's not like I'm swinging for the fence. I have, no risk. Basically, on the upside, can make good money. On the downside, I still have a break even on this one near 223 and a half, another $5. But if we go down, there's quite a bit I can do. I can, roll my short call down, or I could roll, which would turn this into a calendar. I could roll my short call out. But I like these a lot. And the other thing maybe I'll talk about next time, you can go both ways on this, right? If you're following 2 or 3 stocks all the time, if Apple is near, okay, I'm doing a little bit long delta, maybe I'm taking a contrarian position, say, okay, Apple, even though a few weeks ago you could get it at 220 and do a diagonal, but if I felt, okay, we could, bounce from here or whatever, start it from the long delta side. But these are easy to manage, right? And also your longs are quite a bit further out. So, they're easy to work with. But this would be a hybrid, or I call it centaur, a relatively low deltas long for a diagonal strategy, but it combines some of the characteristics of a calendar and a diagonal to give you a very reasonably priced, but much higher yield potential than a conventional covered right. If you want to keep up with what we're doing, check us out at SheridanRiskManagement.com. We just started our 10% class. Our goal to make 10% a month on the option trades. And we do that live and we teach. So you're learning the craft along. And we just started this. This has been our most popular class that we've done over the years. And so we're bringing it back. And if you're interested in that, I think there should be a link here or something. But if you have any questions on this trade, you can email me, Dan at SheridanRiskManagement.com. Have a nice day, folks. Thanks.